Most people believe money is straightforward. You work, you earn, you spend, and whatever remains, if anything, you save. We're raised to see money as a neutral instrument. A way to measure value. Something that keeps society running. But that view is partial. Money isn't only a tool. Money is a system. And systems are designed. The money you use now, the bills in your wallet, the bank balance, the paycheck you expect each month, doesn't function like money did through most of history. To grasp modern money, we must return to where paper currency began. Not in Europe. Not in America. In China. Over 1,000 years ago. But before we get to paper, we need to understand something even more fundamental. For most of human history, money didn't exist at all. People traded. A farmer swapped grain for tools. A hunter traded meat for clothes. A craftsman exchanged labor for food. This was barter. At first, it worked. In small communities where everyone knew each other, barter was enough. But barter had an issue. Actually, many issues. What if the farmer needed shoes, but the shoemaker didn't need grain? What if people argued over value? How many chickens equal a cow? What if goods spoiled before they could be traded? As societies grew, barter grew inefficient. Trade spread beyond villages. Cities formed. Empires rose. And barter collapsed under its own complexity. People needed something better. They needed a common medium of exchange. Something everyone would accept. Something portable, lasting, and trusted. That's where money emerged. Not as wealth, but as coordination. The earliest money was commodities, things that already held value. Salt. Grain. Livestock. Shells. Eventually, metals took over. Gold, silver, copper. Metals were scarce. They lasted. They could be divided. And most importantly, they were hard to counterfeit. Coins appeared. But coins were never just about convenience. They were about control. When rulers began stamping their faces on coins, money turned political. A coin was no longer just metal. It was authority. By controlling coinage, leaders controlled trade, taxes, and armies. Money and power became inseparable. But coins had limits. They were heavy. They were costly to move. And as economies grew, metals grew scarce. This problem showed up most clearly in China. China had a huge population, large cities, and a sophisticated economy, centuries ahead of much of the world. Trade was thriving. But copper coins were heavy. Merchants traveling long distances couldn't easily move large sums. So they found an answer. Instead of carrying coins, merchants started leaving them with trusted agents and carrying written receipts. These receipts stood for money. At first, they were private deals. Then the government noticed something important. People were already treating paper like money. So the state stepped in. During the Tang and Song dynasties, the Chinese government officially issued paper currency. This was revolutionary. For the first time, money wasn't tied directly to metal. Paper money worked because the government promised it would be accepted. And at first, it worked beautifully. Trade sped up. Transport got easier. Economies expanded. Paper money solved a real problem. But it also brought a new danger. Because paper is easy to make. Too easy. At first, paper money was backed by coins. Then partly backed. Then barely backed. Governments printed more money to pay for wars, projects, and spending. And something predictable occurred. Prices climbed. Trust dropped. Inflation arrived. In time, confidence crumbled. People saw the paper was losing worth. China saw some of the earliest cases of inflation and monetary collapse. The lesson was plain. Money doesn't fail when it's invented. It fails when it's abused. Europe watched from afar. And for centuries, Europe refused paper money. They remembered the stories. They trusted metal more than promises. But even metal systems had flaws. Gold and silver were limited. Economic growth wasn't. Banks arose to fix this. Goldsmiths stored precious metals and issued receipts. Those receipts started circulating as money. Sound familiar? Banks realized something key. Not everyone would demand their gold at once. So banks began lending more receipts than the gold they really held. This was the birth of fractional reserve banking. Money was no longer just stored. It was created. From trust and debt. This is where modern money truly starts. Not in China. But in the idea that money could exist as a promise. A promise backed not by metal, but by confidence. And once money became a promise, it could be expanded without limit. That changed everything. When money transformed from a physical object into a mere promise, the rules of the game were completely rewritten. A promise, after all, has no natural limits. Gold has limits. Silver has limits. Paper does not, nor do the numbers on a screen. This is where debt truly enters the story. In the old world, money existed first, and debt came second. You borrowed only what already existed. In the modern system, debt comes first. Today, when a bank issues a loan, it isn't handing out existing money. It is creating new money. Not by printing cash, but by typing digits into an account. The instant you sign a loan agreement, money is born. At the same moment, something else is created. Interest. And here lies the quiet flaw built into modern money. The principal can be created in an instant. But the interest cannot. If every dollar is born from debt, and every dollar must be repaid with interest, where does the extra money come from? It can only come from more debt. This is why the system must grow, always. More loans. More borrowing. More money creation. If borrowing slows, the system tightens. Recessions emerge. Jobs vanish. Businesses collapse. Not because people forgot how to work, but because the flow of newly created money has slowed. Banks sit at the heart of this mechanism. They are not mere middlemen. They are creators. When you deposit money, the bank doesn't store it in a vault waiting for you. Most of it is lent out. Your savings becomes someone else's loan. And that loan becomes new money, circulating through the economy. Banks earn interest on money they created at almost no cost. Risk is socialized. Profit remains private. If a bank succeeds, shareholders win. If a bank fails, it is deemed too big to fail. Governments step in. This leads us to central banks. Central banks were established to stabilize the system. To prevent panics. To manage crises. But they also gained extraordinary power. They control interest rates. They control liquidity. They influence inflation. When central banks lower rates, borrowing turns cheap. People take loans. Asset prices climb. Stocks, real estate, and businesses expand. Those who already own assets benefit most. When central banks raise rates, borrowing grows expensive. Spending slows. Businesses cut jobs. Unemployment rises. Wage earners feel the pain first. This cycle repeats, again and again. Boom. Bust. Recovery. Crisis. And through every turn, one pattern holds. Assets inflate faster than wages. This is no accident. Inflation is often described as rising prices. but it's better understood as declining purchasing power. Your money buys less over time. Not because things are worse, but because more money exists. Inflation quietly transfers wealth. From savers to borrowers. From workers to asset owners. From the many to the few. If you hold cash, you lose value slowly. If you hold assets, you stay protected. That's why those who understand the system chase assets, not savings. Now consider this. If modern money isn't backed by gold, if it is created through debt, if its value depends on trust, then what, exactly, is money? It is a social agreement. A shared belief. Money works because we believe it works. The moment that belief fractures, the system trembles. History shows this, again and again. Hyperinflation. Currency collapses. Bank runs. When people rush to turn money into real things, the illusion fades. This is why governments protect confidence at all costs. They insure deposits. They bail out banks. They reassure markets. Not because the system is strong, but because it is fragile. Modern money survives on narratives of stability. And now, money is changing once more. Cash is fading. Digital payments are rising. Physical currency is growing rare. This is convenient. But it also introduces something new. Total visibility. Every transaction tracked. Every payment recorded. Every account monitored. The future of money is efficient. But efficiency brings control. Digital money can be frozen. Limited. Programmed. Spending can be restricted. Behavior can be influenced. Money becomes permission-based. This isn't science fiction. The infrastructure is already here. And this returns us to where we began. Paper money in China was invented to solve a practical problem. Modern money exists to manage a system. A system built on debt, growth, and belief. Understanding this won't make you rich. But it will make you aware. And awareness is the first step toward freedom inside a system you cannot escape. Step back and look at the system as a whole, and one question becomes impossible to ignore. If money keeps growing, if debt keeps expanding, if inflation slowly eats purchasing power, then who actually wins? And who quietly loses? The winners are no mystery. They are the ones closest to money creation. Banks borrow at the lowest cost. Large corporations access cheap credit. Governments spend before inflation shows up. Asset owners see prices rise. Stocks climb. Real estate inflates. Ownership multiplies value. Meanwhile, wages lag behind. Most people trade time for money. And time does not compound. A salary increases slowly, if at all. But living costs rise every year. Rent goes up. Food becomes expensive. Healthcare costs explode. People are told to work harder. But effort alone cannot beat a system built around asset inflation. This is why two people can work equally hard and end up in completely different financial realities. One owns assets. The other depends on income. The system rewards ownership, not effort. And this creates frustration. People blame themselves. They feel behind. They feel late. But the truth is uncomfortable. The system was never neutral. It was designed for stability, not fairness. Debt-based money requires growth. Growth requires consumption. Consumption requires pressure. So people are encouraged to borrow early. Spend often. Stay dependent. Education teaches skills, but rarely teaches money. Not how it's created. Not how it flows. Not who controls it. Because once you truly understand money, you stop seeing it as a personal failure. You see it as a structural reality. This doesn't mean the system is evil. It means it has incentives. And incentives shape behavior. Governments inflate because inflation is easier than default. Banks lend because interest fuels profit. Markets chase returns because cash decays. Everyone plays their role. Including you. The moment you earn money, you are inside the system. You cannot opt out completely. But you can stop being blind. Understanding money changes your psychology. You stop worshipping it. You stop fearing it. You stop blaming yourself for structural outcomes. You start asking better questions. Why do assets rise faster than wages? Why does debt never disappear? Why does money lose value over time by design? These questions matter more than quick tips. Because money is not about tricks. It is about positioning. Positioning inside a system that runs on belief. Remember where this all started. Paper money in China was a solution to a logistical problem. But modern money is a solution to a political and economic challenge. How do you fund governments without visible taxation? How do you grow economies without real resources increasing? How do you keep stability in a fragile system? The answer was belief. Belief in currency. Belief in institutions. Belief that tomorrow will look like today. And as long as that belief holds, the system survives. This video is not telling you to reject money. It's telling you to understand it. Because money doesn't control you through force. It controls you through ignorance. Once you see the system clearly, your relationship with money changes. You stop chasing numbers. You start thinking in terms of value, ownership, and time. You stop asking how to get rich fast. You start asking how to avoid being quietly drained. This is not pessimism. This is clarity. Paper money started in China. Modern money became something else entirely. A system of debt. A system of incentives. A system powered by trust. And now you know how it really works. This was Money Explained. If this video made you see money differently, stay with the channel. Because understanding the system is the first step to navigating it. And this was only the beginning.